Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, welcome to another amazing show. We build great apartment communities and improve how people live. So thanks for tuning in. I have here another amazing guest, Jeremy Roll, and I want to introduce you. Jeremy, very unique background, has a very diverse background in commercial real estate and various asset classes, including multifamily, industrial, self-storage, mixed-use product, and businesses. Jeremy's been investing passively for about 13 years, but as an investor overall for 18. He also is the co-founder of For Investors by Investors, Phoebe, and I know we have a chapter down in San Diego that I actually went to, probably about 8 years ago. And so I'm familiar with it. I'm familiar with the chapter, some good folks down here hosting that chapter. So Jeremy, welcome to the show.
Thanks for having me on. I really appreciate it.
Yeah, you're very welcome. Hey, so I'm going to start off with a couple different questions. One question that I think would be really appropriate to start off with, especially with our audience, because I'm very familiar with this. Can you talk a little bit about Phoebe? I know, you have a national footprint, about 30,000 members at this point, of different investors that participate in that group. You helped found this. How long has it been now? About 10, 12 years?
Yeah, so we started that in 2007. Actually, okay. It's been about 13 years. That was co-founded by myself and another investor named Ellis San Jose. And the concept was that I was basically running around trying to learn and network at meetings in Los Angeles where I live from 2002 to 2007. And 2002 is when I started investing passively. And once I left the corporate world, which I got out of from the cash flow, I was sick and tired of going to meetings that were sales pitches. And the true story is that I would go to a lot of sales pitches a couple of times a week to be able to network. And what I would do is I would sit in the back row, I'd bring work, okay? And then I would do the work, literally do the work for 2 hours in the chair. And then I would wait till it was done. And then I would network, right? I wouldn't pay any attention to the sales pitch. And the first meeting I went to after I left the corporate world, I got to the meeting and sat down and realized, I said to myself, oh man, I don't have work to do. And I was like, why am I going to, so I was like, okay, I got to sit through the sales pitch. So after sitting through that sales pitch, I said to myself, like, why am I wasting my time in the sales pitch when I can run my own meeting where the core foundation is no sales pitch and I'll have to sit through a 2-hour sales pitch. And that's kind of what happened, in terms of how Phoebe started. I eventually met Ellis San Jose, who had a like mind, and he was also running his own similar meeting where there was no sales pitch. So we started that as a nonprofit. We actually lose money off of it every single year. That's that's a given. And our goal is to really unite investors, just help each other learn and exchange information and network where there's just going to be, we're really hardcore no sales pitch. That's why I would start it. As far as the footprint, most of our chapters are in Southern California. We're really, really picky about who we take on as chapter leaders. And so when we have chapters out of state, it's because a chapter leader has moved out of state and we know them really well. And they're going to start a chapter somewhere else. Because the one thing we don't want happening is somebody shows up to a chapter in Nebraska of someone running it that we don't know well, and then their sales pitches, and we're not there, we can't confirm that. So we only take on chapter leaders who we've known for years, who are true real estate experts that we know well, who we know will not pitch. That's why most of our meetings are concentrated in Los Angeles. We have one in Orange County. We had one in San Diego, the one you're talking about. That one eventually, in fact, what's funny is that the last guys who were running that came to us and said, look, we have to start selling our own program. And they were good guys, and they're smart guys. They provide really good education. And we said, look, you can't provide the education. You can't pitch your education at the meeting. So they kind of continued their meeting on, but they're not FIBI anymore because, we're not okay with the pitch. So we don't have a meeting in San Diego right now. We have one in Orange County, a number in LA, and we do have some of them that are virtual. So if anybody wants to find one right now, and no matter where you are in the US, you can log on to meetup.com, type in For Investors by Investors in the search box, or you could try FIBI, Phoebe. And in LA, we certainly show up if you put in Phoebe. And you might find some of our virtual meetings that you can attend from wherever you are right now during COVID.
Interesting. And give some perspective on the topics discussed, right? Because real estate investing is a very big topic, can be very broad. So for someone really looking to participate or log in to learn a little bit more about Phoebe, what can they expect, just roughly speaking?
So the way that Phoebe works, it's very decentralized. And we take on a chapter leader. They get to choose what the meeting's even going to be about. So I'm going to give you some examples. So we have a chapter in Pasadena, California, and that one is for single family and apartment investors, okay? And they're not going to talk about self-storage or mobile home parks. They're not going to talk about non-real estate stuff there. You're going to get single family or apartment information. And so you would maybe join that one because you're into those specific asset classes. And then each month, there's going to be a topic that's going to be relevant to those asset classes. Most of our meetings are actually panel discussions with several panelists each month. That particular meeting, Pasadena, is run as individual speakers typically. And so I would encourage people to not only make sure that the chapter itself matches the type of content you're looking for, but that the month that you're going to attend, because we typically do them monthly, matches that particular topic's interesting to you, right? So if you're in Pasadena or you're anywhere in the US and you want to go onto the virtual one and you're investing in apartments and that month they're talking about single family, then that's not for you, but the next month it might be for you, right? We've had chapters of all different types. We've had stuff, Cash Flow Investors Unite. We've had macroeconomic chapter that I used to run. We've had all kinds of stuff, but most commonly it's going to be some aspect of real estate, and each month it will be different. So you're just going to want to pay attention to the chapter that's nearest to you, or not right now virtually, you can look at all of them and figure out if that might be a good fit for you.
Awesome. Awesome. Well, Jeremy, I'm going to get right into, a discussion. We love commercial real estate. This show is about commercial real estate, of course, multifamily product. So I'm going to ask you some questions now and really get into this, bring our audience into this conversation. So, you've been invested in various asset classes, right? I mean, you've been doing this for quite some time, including businesses. So can you talk a little bit about why multifamily real estate? What attracted you to multifamily real estate?
Yeah. So, it's interesting. I find that multifamily has a commonality amongst many, many investors, which is that it's a very often an asset class that people might start with because they've actually lived in a multifamily building before. They can relate to it. It's an easy business model to understand. And it's pretty easy to understand there's going to be a lot of predictable demand going forward, right? Now, when I started getting into this type of investing back in 2002, the passive investing, the reason why I did personally is because I wanted to get away from the lack of predictability of the stock market after the dot-com crash. I was just sick and tired of the stock market due to the lack of predictability for my long-term retirement account. And I'm a pretty low-risk, slow and steady guy, so the predictability was really important to me as like a long-term plan as an investor and for my retirement account. And so apartments is, in my opinion, it's actually one of my top 4 asset classes for the next 10 years, post-COVID, post-recession, for predictability, right? It's got to be in the right areas. I'm not necessarily looking at deals today personally just because I'm waiting to see how the whole recession unfolds. Everyone's got different risk profile. But the bottom line is that for me, that's one of the top 4 asset classes that I see for myself for predictability in the next 10 years. If you got the right operator managing it, you're in the right location, and you're in a growth area, et cetera, right? So that's the real appeal to me is I'll look at stuff that's maybe 80 to 100% occupied in a strong growth market, population and economy-wise. And I'm just looking for predictable cash flow. For me personally, I live off the cash flow. I have been for 13 years. And so I want to go to sleep tonight, wake up tomorrow, and not much has changed. And one of the things I really like about apartments specifically is that I can invest, and I typically do target 1 to 400 unit apartments, non-institutional type size. And I love the tenant diversification. So if one person leaves tonight or tomorrow or yesterday, I'm not really going to feel that much of a difference. That's a huge benefit to me. I'm all about diversification, not just in apartments, but even in all my asset classes, operators, geographies, et cetera. So I love apartments for many reasons, and they're definitely my top 4 for the next 10 years when I'm looking for more predictable cash flow.
And then just out of curiosity, what are the other 3? So if you had to list them from 1 to 4, what would they be?
Yeah, in no particular order, right?
Okay.
So mobile home parks, self-storage, senior living, and apartments. And I will tell you right now, for example, senior living, which is very interesting to me because of strong demand in the right area, you have very high occupancy, you can get really good returns. But during COVID right now, that's a very risky asset class, right? Because even if a facility hasn't gotten COVID spread through it yet, it could happen in a month or 2 until there's a vaccine. So I'm completely standing by on that one, right? Even so, in other words, those 4 are meant for me for the next cycle for predictability and my tier 1 that I'm going to be targeting. But It doesn't mean that the timing is right today. But I love all those asset classes for what I think are going to be predictable demand in the right areas.
Okay, good. I really appreciate the commentary, and I think that gives, that starts a very good discussion now as we pivot into COVID-19. So, we're in a very unique environment right now, especially when you start talking about or having discussions around, looking for an asset class with a stable or predictable income stream. And you gave, 4 really good examples. So how do you feel COVID-19 is changing the real estate landscape, right? I mean, what are your thoughts on that?
Yeah. So keep in mind, I'm one person's opinion. I'm not an investment advisor, so I think I'm sharing here just my perspective as an investor, right? And it's certainly just one person's opinion. So I'm really low risk. So I've been mostly on the sidelines since the end of 2016 for my own investing. Okay, I've really pushed my sponsors to sell into the end of the cycle. I've been involved in over 30 sales in the last 3 years into the end of the cycle. And so normally what happens in a recession is that I look to discover a few things as an investor. I want to see vacancy discovery. In other words, recession starts, people have to leave, no matter what asset class. Well, let's take apartments, right? So people can't afford to pay, they have to move home, they have to double up, whatever it is. Vacancy increases, supply increases as a result, market rents decrease to adjust for that, right? To attract more tenants. And then eventually net operating income goes down as a result of lower rents with the same number of units, correct? Mm-hmm. And then eventually what happens is that investor sentiment is hit as well. There isn't as much demand for those assets. And then cap rates will adjust because people aren't willing to pay the same multiple they were before because of fear and other reasons, okay? So you have a lower multiple on a lower NOI and prices come down, okay? That's just kind of like the typical textbook recession playbook, right? So, and that process takes about a year or two to actually unfold and completely hit bottom on a typical historical recession. This recession is very different. And the reason why I say this, and by the way, I hate that expression. I am not that guy that says, oh, this time it's different. And so I do think that,
That's
I tell
funny.
you, because I actually, my big thing is I try to apply history to be able to help predict the probability of the future.
No, that's smart. That's smart. Right? Hey, well, at least you're not the economist that gives 2 opposing scenarios and then says, well, maybe it will be this or maybe it will be that. And yes, that's what I predicted the future.
Right. There we go. So, but for me, what's happening in this particular downturn is that we saw fear when the stock market tanked in March. We saw people start to actually have the dominoes of what would have been a normal recession. But about a month and a half later, with all the stimulus that was announced, that went away. Stock market went up. And with all these stimulus programs right now, I like to think that the recession has been delayed. That's what I'm saying. Okay, that's my opinion. And I believe that the recession's been delayed by stimulus. I believe that the second round of stimulus, which they're working on right now, will likely be a little smaller, and we'll start to get some of those dominoes start to fall, along with a lot of business bankruptcies, unfortunately, this fall, which will be some of those dominoes. And I think by the time the election's done, stimulus will be much lower starting into next year. Most of those dominoes will then really fall, and then we'll start to discover what the recessionary effect will be on real estate. So to me, I feel like we've been delayed about a year, maybe a little bit less, in seeing the dominoes fall. As a result, what I'm doing, because I'm highly conservative, is I'm just waiting, right? I've been waiting a long time already on the sidelines, and I made many investments between 17 and 20, but they all had to be unique, and I was being very, very careful with pricing, and also asset classes that make sense during a downturn with the cycle ending. And right now, I'm completely on the sidelines unless there is an absolute no-brainer, because I have to get that discovery to happen so that I can get comfortable with going into an asset maybe next year or the year after, understanding how the pricing will adjust, how market rents will adjust, how vacancy will impact market rents, et cetera. I just haven't been able to discover any of that yet. So it's been all delayed.
Okay, good. So I really appreciate that perspective. Now, you have a unique viewpoint, right, when it comes to investing, because you invest predominantly as a limited partner, right? Yeah. And so you're 100% passive in it sounds like everything that you do.
That's right.
Okay, so this will be a great discussion then. So what are the top 3 qualities that you see in a successful multifamily sponsor?
Okay, so first of all, the best fit for me is someone who's conservative. And that's both a question of my personality, but also because I'm looking for more predictable cash flow, and I want the probability of that to be as high as possible, right? So I want someone who's conservative.
So define that really quickly, Jeremy, because if 10 people sit in front of me and I ask them to define what conservative is to them, it would be a little different for everybody. So
Sure.
could you define that a little bit?
Yeah, I think the best way to kind of give you some examples, I'm looking for someone who's looking to underpromise and overdeliver to build long-term relationships with investors, and that maybe we'll use numbers that are more conservative, like a bigger vacancy factor, maybe lower rent increase assumptions, certain things, a higher cap rate on exit. You can kind of start to piece the puzzle together by looking at some of the data and even speaking to the person and telling if they're a really conservative person or not by nature. And I'm looking for that person who's looking to underpromise and overdeliver. So that's kind of how I would define conservative for me, is underpromise, overdeliver as a philosophy. And what I'm trying to avoid is the opposite to me, which is someone who's being really aggressive, using very strong numbers to have a really strong marketing piece and have high returns in their business plan to attract investors. And they just want to get their investors close the deal. And if they don't have that investor repeat the next time, they don't care because they have a big marketing machine or whatever it is. They have enough investors, right? So I'm trying to avoid that type of personality because I live off the cash flow. So that predictability, the pro forma, the projections are very important to me because I'm going in under the assumption that there's conservative projections that we're hopefully going to hit, right?
Sure.
So that's really important from my perspective. So that's kind of number one to answer your question of the top three, okay? Number two is I want someone who's experienced. This is not going to sound good, but I'm just being honest. I try to avoid I don't want someone learning off my money because it's their first or second deal.
Very smart.
That's just the honest truth. So
very smart.
Someone's brand new, I'll watch them, I'll see how they perform, and then eventually I'll jump in, but I'm not going to be the first or second deal that someone's going into because I feel like my probability of success might be a little lower than if I can go with someone experienced. And like everybody else, I've got limited capital and I have to be really careful.
Right.
So I want someone who's experienced. I want someone who is conservative, and I want someone who lines up with the type of asset class and location that I target. Okay. So for example, I'm looking to invest in a Class B asset in an A- or B market outside of California for higher cap rates and higher cash flow, because that's what I'm targeting. And I also avoid hot markets, not just volatile markets, but hot markets. So for example, Seattle and Denver, I love those cities. I've been to both of them the past few years, multiple times, but I've avoided investing in them in the past few years because those are hot markets. Cap rates are too low for me in terms of cash flow. And also I try to avoid what's hot just as a very conservative person. So I want someone who's going to match the criteria that I'm trying to find and look for a similar type of product in a similar type of market that I'm comfortable in. So those
okay. And so can you shed some light on what that criteria is? So, when you talk about your criteria, can you talk a little bit about that in terms of, cash flow, returns,
sure.
just to shed some light on, to make it tangible for most people, right?
Sure. So, I'll talk about the last cycle because I say this because the way that I work as an investor is that I put a certain target minimum, preferred return, targeted cash flow, cap rate, okay, that I set for each asset class that I'm going to invest in at the beginning of a cycle. And then what happens is that I start running through a cycle, and as soon as something doesn't meet that criteria anymore, I drop off of that asset class and continue with the others. Now, I will still invest in that asset class if there's exceptions or if there's the right pricing or something does meet the criteria, right? But on average, like a market rate deal, I'll drop off of market rate deals at some point, right? Now, I'm going to tell you what I did last cycle. The problem is that it's not really applicable right now because we're about to reset and go into a new cycle based on the fact that we're in a recession. So what I can't tell you yet, because we haven't gone through that whole domino discovery that I've been talking about, I don't know what my new target's going to be because I've got to be reasonable and say to myself, look, interest rates have come down over time. Returns might be lower in the next cycle than I was able to get last cycle. Cap rates might be lower. So I got to wait and discover that and set my new target. So I can't tell you what they're going to be yet. It's too early. Okay. But on the last cycle, and remember, I started this cycle in 2009. That was a long time ago. So anyone who's been investing for 2-3 years, these numbers are going to sound high because the cycle started with the different cap rates back then, right? They compressed over time. Right. So I was targeting a multifamily specifically with a Class B asset. I was targeting a minimum projected annualized cash flow of 9% year one net to investors and a minimum of 11% average annualized cash flow projected net to investors over, say, a 10-year projected horizon. Okay. Now I focus heavily on the cash flow, so that's just the cash flow component of targets that I had. When you add in mortgage pay down and some assumed depreciation, the typical thing I was investing in was projecting about 15 to 18% annualized return, but that was secondary to me. It was all about the cash flow. So I had my cash flow targets in a Class B asset once I got under 7.5 cap purchase, I got very, very, what's the word? Antsy is probably the best word, for lack of a better word. And so I don't think I would have considered anything below a 7 cap at all. But 7.5 was where my gray line was. The black line was truly at 7.
Okay, so let's talk about that a little bit, right? Because what you described in 2009, you're right, very difficult to come across today.
Mm-hmm.
Okay, but not impossible. Okay, not impossible at all. In fact, I closed on one that shared some of those characteristics, which is why we bought it. But they're not common opportunities, right? Which is why there's so much opportunity in this business. If everybody can find and uncover and create those opportunities, first of all, there would be none.
Yeah.
Right? There just wouldn't be that. There wouldn't be these kind of opportunities. But because we are in a free market, okay, not now, but when we move out of this, we'll get back to a free market. I think those opportunities will become more and more common, maybe not to the degree that you carved out, but they still will be there right now. So here's the question. So here's the follow-up question to that is, where do you feel you can find the most profitable investment opportunities, or at least the opportunities that would be fairly close to the criteria that you carved out, right? So I'm going to break that down into let's start off with a metro, or a metro submarket asset class. So as you're starting to reset your criteria now, based on what you described, what markets do you feel strongly about?
So let me just backtrack and say that including in direct assets and funds that have owned assets in multiple states, I've invested across 43 states. Okay. So what I've learned about the US, because I'm originally from Montreal, Canada, and I've been here about half my life and there half my life, is that there is just an unbelievable number of markets that I would have never known if I hadn't not been open-minded to them. Okay. Because I've been in many places and checking out a lot of these properties has been fascinating. And so I don't have a specific market that I'm targeting. I'm actually more of an exclusionary guy as opposed to an inclusionary guy, right? And then I can tell you I'm not open to most places in California because of cap rates. I'm not open to Manhattan for the same reason. I'm not open to hot markets like we talked about, right? But then I'm open to a lot of other stuff. What I will say is that philosophically, I want to be in the market that's got a growing population and a growing economy. And here I can tell you this high level. Statistically, it's projected that Florida and Texas are the number 1 and 2 states for population migration for the next decade, right? Mm-hmm. So I can tell you that that's a great starting point. I can also tell you that a lot of the northeastern states, like upstate New York, for example, is projected to have a population decrease, right? Or at least not be strong. And that would make it much less probable for me to invest in those areas, right? But again, I wouldn't necessarily rule that out until I looked at the numbers in that exact portion of New York State, for example. I'm not trying to pick on New York State. I just happen to know because I used to live near there. So, sure. And that's upstate and it's not very big population base, et cetera. I'm just using an easy example that I know. So the point I'm trying to make is that I'm not targeting any specific metros. I know a lot of apartment operators might target 1, 2, 3, 4 metros for themselves to really get to know them and get to know where they're investing. The benefit I have as a limited partner, as a passive investor, is that I can invest across almost anywhere because I'm leveraging someone else's expertise to actually identify that market. Then I verify if I agree with that business plan or not. So I don't have a very good answer for you in that it would be a lot of markets.
Okay, good. Well, no, I really like the way that you approach that as the exclusionary, I like the way you said that, right? I tend to focus more on markets that I don't want to be in so that I stay open to markets that have opportunity. I really like that. And I appreciate you sharing that. So now I'm going to pivot a little bit and still leverage your experience as a limited partner and share a story about your most profitable investment, right? Multifamily investment.
Multifamily specifically.
Yeah, share a story about you, because you've invested in many different opportunities across the United States. Yeah. So share a story about your most profitable deal and what that looked like. Okay.
I will share a quick story. So this is a great example of what you said before, is that there's always opportunities out there that are just really hard to find, and the unusual ones make sense at any time. At any time, someone brings me a no-brainer tomorrow, I'll do it. Even though I said I'm on the sidelines, right? You got to really be open to that at any time. So 2015, oil crisis, oil is below $30, right? I get approached by a sponsor I've invested with many times, over 10 times. He brings me a deal that's 91% occupied, I believe. Maybe it was 90, 88. Anyway, it was really close to that. And he says, look, I got a deal. I know oil's crazy right now. The oil market's really down, which to me is opportunistic. And he says, I've got a property that is, have you heard of Starwood?
Yes.
Okay. Big, very big owner, big private equity firm. He says Starwood has a portfolio. They want to sell off, but they have one property that doesn't match the rest. It's non-institutional. It's like 300 units. They've offered it to us. They just want to get rid of it. Okay. We were able to buy that property at true 2008 pricing per door. Okay. So I think it was like 300 units. I forget what the door price was, but it was like $18 million. Okay. It was like 90% occupied, 91% occupied. And the rents in that market were down tremendously, very volatile because of the oil markets and the demand shift. I don't normally go into a market like that because it's not really as predictable, but we were getting in at the exact right time at the exact right price basis. So someone brings you a deal in 2015 that's at 2008 pricing, you've got to look at it carefully, no matter what market it's in, right? So we bought that building. They did a great job managing it. And I think we sold the building in 2018 for $34 million. Now, now, here's the thing to keep in mind, okay? That sounds great, and it was great, but what's even crazier about it is that it was 90% occupied, stabilized, cash flow deal. This wasn't like a value-add deal. We didn't go and turn all the units and actually rehab them. There was like almost nothing that went into it. It was a pure value play that ended up being fantastic cash flow, if you can imagine, right? I forget the exact cash flow rates because of the basis that we had. Right. And the whole premise was that when the market was going to get better, because oil is cyclical and it does turn around, that we were able to turn and sell that building. And it could have been in 10 years and it could have been in 3 years. It just happened to be that they took advantage of a run up and cap rate compression when the market was more normal and oil prices were more normal. So that's one example. With leverage, I don't remember what the IRR is, but with leverage, you're almost doubling your asset value in 3 years. That's pretty strong for someone who's just looking for like 10% cash flow or 11% cash flow and is getting into that type of deal. Right.
Yeah, no, I get it. And that's a great example. So what was the biggest lesson learned there?
Biggest lesson learned, like I said before, is always be open-minded. Even like now, we're in the middle, it's the exact same situation, right? We were like in a market nobody wanted to be in because it was like oil was below 30. It was just carnage everywhere. But if you take all that away, it's the Warren Buffett approach. It's like be greedy when people are fearful and be fearful when people are greedy. And when people are fearful, you've got to be careful. But there are a lot of opportunities out there, so be open-minded. I think the lesson is be open-minded to something because a no-brainer can make sense to jump on at any time, even today or tomorrow in the middle of a recession.
Yeah, that's really great advice, great perspective. And so now share your least profitable multifamily investment.
That's a good question. So, all right, can I share I don't know if we have time, but I have the most fascinating, unique story. It's what I call the 1% risk of investing in any asset class at any time as a passive investor. I can tell you 20 ways a deal can go bad that you would have no control over, that you can never get rid of, besides Ponzi scheme, fraud, and mismanagement, other things. This is the epitome of like,
man, that's classic.
What I tell people too is that, I invest in stabilized stuff. So you invest in something that's 100% occupied and well-managed and with an experienced operator. It's like an airplane, like a modern airplane. You got to have 6 dominoes fall before the airplane comes down, not 1 or 2, right? This is that exact story. Okay. So I invested in student housing multifamily. Okay. 2008, January 2008. I'm convinced there's going to be a recession, but I say, look, students go back to school during a recession. I'm not worried about this at all. I invest with a sponsor, very experienced. It was their 17th property that they held in their portfolio. Most of their properties were not syndicated, so they were very wealthy. They only syndicated a couple. And it was the first property across from a state university campus in Michigan, okay? It was, for all intents and purposes, 100% occupied. It was 303 units, I believe. We got a really good deal. There was a partner dispute, so that's why it made sense at that timing. And we assumed a loan that was due in 2012. Now, normally, I actually invest in 10-year loans for more predictability. But in this case, it was a great deal. By 2012, I was pretty sure that the capital markets would be okay because I was expecting recession truly that year. And so I wasn't too concerned about the end date of the loan. So fast forward, for first few years, no problem. Everything's perfect, cash flowing, 100% occupied every year. Early 2012, there's a letter that comes to all the tenants from the city as well as to us, and it says, we've got to close the bridge to campus for repairs during the summer because we can only fix it. This is true. This is true.
Oh,
and
that's classic.
they say, but don't worry, we know you have to get to school in the fall, so the bridge will be open in time for school. No need to worry. Okay. So our occupancy goes from 100% to 65% for that fall.
Oh,
okay?
wow.
That was domino number one, right? That actually would have been manageable for a year. Okay. Domino number two, our loan was due that fall.
Oh, boy.
Domino number three, the appraiser comes in, appraises it at 65% occupied, and it can't make up for the refi, right? Domino number four. Domino number four. The bank does not want to extend the loan for a year on a property that's going to obviously be 100% occupied in a year because they wanted it back for themselves.
Of course. You had investors who bought the note. Very interesting, right? I mean, that you want to talk about the perfect storm. I mean, that was the perfect storm.
Yeah. So that's actually not the end of the story, though.
Oh, man. Then there's more?
Yes, there's more.
But wait, there's more.
That's why this is such a crazy story. So property gets foreclosed. The only foreclosure I've ever been in 18 years. Okay, property gets foreclosed. Partial recourse loan is taken off by is absorbed by the general partner. Now, so at this point in the story, that should be the end of it, right? Because you're an investor, we got foreclosed, it wasn't a forecastable thing, the GP did nothing wrong. Right. It was the 1% risk that we're talking about. That's why you've got to be diversified, right?
Right.
But here's what happened. The general partner really felt bad for the investors, and they said, you know what, we're going to transfer everyone's interests into another property that we own ourselves, first property across from another state university in Texas, because we feel really bad. So they actually transferred everybody's interests. Took about a year of legal and accounting work. We didn't get cash flow for a year. Within a year, I was in another property that was 100% occupied, as I mentioned, in a very similar location, another state university. And I've been in that property ever since, cash flowing every year.
Interesting.
Yeah, so my only foreclosure ever was actually not like a loss from my perspective.
But here's what's really interesting about what you said, right? Because of the integrity of the sponsor and that sponsor's care for his or her partners, they were willing to make everyone whole, right? It took a little bit of time, but they were savvy enough to exchange that interest into another asset that they felt strongly about to preserve everybody's position. And I think that's great. I have done that. I've done that in the past. I didn't take a loss. Okay. I didn't take a loss, but we didn't come out as we projected, right? I mean, it was substantially below what we projected because of some construction issues that we ran into. We had a perfect storm as well. But I made everybody whole. And all those folks are still with me today. In fact, paid them 4% on their money, right? And then we immediately rolled into something else. But I get it. So how did that change you when you worked with someone like that?
Well, so first of all, the first thing it did is reinforce what my personal belief that when I'm investing as a passive investor, I tell people that as a passive investor, I give up control in exchange for diversification. That's my perspective on it, right? So I could put a small pieces across a lot of things and leverage a lot of different expertise across a lot of asset classes, investing passively as a result. But because I'm giving up control, in my opinion, the number one thing that's most important that I have to focus on is who am I making a bet on? The number two thing is the actual property. And the property is a very, very close second, but I really believe that the person who I'm making a bet on is number one. And in fact, when I invest in startups, it's the exact same thing. Who am I making a bet on is number one, and I have to make a bet on them. I'll invest in a startup. Otherwise, I don't look for startups at all. Okay, so same philosophy. And I would say that another really interesting lesson for that particular story is that, look, this GP had no legal obligation to transfer us. Had already lost money on a partial recourse loan, and then took money out of their own pocket to transfer us into their interest in this other property. So the lesson here is it's a bonus to invest with someone who has a lot of financial means, who's wealthy, because they can choose to make things happen sometimes, whether it's avoid a cash call because they make a loan, all these different scenarios. But the more important thing, frankly, is even if you invest with someone wealthy, they have to choose to actually do that action because they have no legal obligation, right?
That's right.
You have to have the right mentality, to your point, along with the means for that to actually work. So there's a lot of good lessons there. It's a very unique story.
Yeah, no, I love that. And that's a great story. And I appreciate you sharing. So, we're towards the end of the show. We're going to start wrapping this up. Jeremy, I want to really thank you for being on. I have a question here, a final question that I want to get to because I think it's going to help bring everything together, because this has been a tremendous conversation, especially from someone who is, a limited partner, right? I mean, that's all that you do. You've been in over 60 different investments, probably 100 different limited partnerships, right? Or in this case, LLCs.
Many more than that, yeah.
Okay, so you're going to appreciate this question, and our audience will as well, because we have a lot of operators who tune in. We also have a lot of limited partners who participate and are engaged in this conversation in our show. And then we also have folks that are just looking to get into this business, right? Especially commercial real estate. So, here's the question. What advice can you give our listeners about being a sponsor that investors admire and respect, especially, pivoting from the conversation that we just had earlier, right? So you've interviewed, vetted out, traveled all across the country, and even out of the country for that matter, vetting sponsors. So how would you answer that question? What could you share with our audience about that?
Yeah, great question, by the way. So a few key things come to mind. First of all, I would say that, do your best to use conservative numbers to try to underpromise and overdeliver, because that's how you're going to build long-term relations with investors, and investors will have a lot of respect and a lot of appreciation for you doing that. That's number one. Number two is communication is key. And I don't just mean, responding to an email in a couple of days or whatever. I'm talking about like your quarterly reports. How detailed are they? How understandable are they? How transparent are you? I will say this. I know on this side of the table, actually, this is something I've formulated an opinion on over the years, but I'm convinced that there's plenty of sponsors who they're in the business of buying and running a property and optimizing it and exiting down the road. They're not necessarily interested in dealing with investors. In fact, for some of them, investors like the least favorite thing that they're doing. There are some sponsors who aren't that big, who don't have an investor relations contact or department, and they're having to deal with all these investors, and they hate dealing with the investors. And I get that. I understand that is because that's not the business. They're not in the business of managing investors, in the business of operating a property, right? That's what they want to do.
Sure.
That's why I got into this. So at the same time, though, as much as you may not like it as a sponsor, it is an important component in terms of investor relations, right? So be as responsive as possible, be as communicative as possible, as transparent as possible. The level of reporting that I see is all across the board, right? You can only imagine. I've been in so many deals, and it's literally like I've seen amazing reports, I've seen very bad reports, and everything in between. The better the communication you can do, the more likely it is that someone's actually going to reinvest with you. I've been in personally and seen many situations where something overperformed projections, but I would never invest with, and other investors I knew would never invest with that sponsor again, regardless of the actual execution, because of the degree of poor communication, whether it's lack of responsiveness or whatnot, maybe with delayed quarterly reports, delayed payments, delayed tax, whatever it is. So that investor relations component is very important for the long-term viability of your business, no matter how well you actually execute on the property. So that's very important to understand as well. It actually amazes me because execution is the most important thing from an investor perspective, no doubt. But at the same time, the investor relations can be very, very important for a sponsor long-term.
Well, I really appreciate that. That's just a great perspective, especially from someone who lives that day in and day out, right? I mean, that's your livelihood. So you've really dialed in your approach there and your understanding of how to vet out quality sponsors that you feel will execute and perform, right? So very, very unique perspective. And I want to thank you for, participating on the show and sharing, your experiences. Last question is, what is the one question that you have for me that you would like to ask that you feel may be relevant for our audience? And then I'm going to finally have you share how folks can get a hold of you, especially with especially with Phoebe, because I think it's a great entry point for a lot of folks.
Sure. So my question for you is, I've shared my perspective on COVID and the economy. What's your perspective on COVID and the economy?
Yeah, I appreciate that. In what sense, right? I mean, can you narrow that down a little bit from what viewpoint?
Yeah. So, how is COVID impacting your investments today?
I really appreciate that question. So for us, fortunately, we're performing really well. And I think the main reason for that is about 3 years ago, we decided to build out a property management company to be able to extend ourselves into the markets that we are in that are out of our primary area, which is San Diego, right? So now that we're in Texas, we also have teams out in Texas. We're expanding into North Carolina as well. So we're building out a team out in North Carolina. But the biggest, I think the decision that really allowed us to be able to not only weather what we're going through, but to perform at our standards was the fact that we made a decision 3 years ago to be virtual, to be able to manage assets anywhere in the United States. And now I feel pretty confident about us saying that we can manage assets anywhere in the world for that matter, as long as they fit within what we understand, right? I mean, we've built out some great systems. We've hired on a great staff. We have a great team of people. And they've really bought into our philosophy and our purpose of building out great communities and improving how people live. And, you know, I believe once we focused on systems, then we hired people to run the systems, and then we all rallied them around a common vision. In this case, we call it our purpose. You know, if you know the business, right? If you know the business of investing, in this case, in multifamily real estate, and I believe you really take care of your customers, right? In this case, our residents. The byproduct is profitable communities. And that was a major shift with us. And we're seeing the benefits of that now. You know, we're outperforming in all areas, right? I mean, all of our properties at this point are 100% occupied. Okay, all of our units. And now here's what's really unique though. You know, when we do have a vacancy in some of these markets, including our from turn to lease up, we're at 2 weeks. So in many cases, because of the marketing systems that we put in place and the processes that we put in place, you know, we have a very good tenant list, right? Folks that want to get into these properties. And then when we do have a vacancy come up, you know, we're able to fill that really, really quickly. And that has been just process, right? Continuously refining process over the last 3 years. And it was all driven by a challenging experience. Like one of the examples that you mentioned, and it was I'm so grateful for that, because here's what happened. You know, the minute we went out of state, our process broke. It literally broke down. And so it really put us in a different mindset where I had to say, okay, you know, we have to take advantages and leverage this as an opportunity, because it's broken, right? And so our systems got exposed, right? But if this didn't happen 3 years ago, I couldn't imagine building this now. So fortunately, because of that experience, we were forced to rebuild, and we made a decision to be able to do everything virtually, or meaning communicating with our teams. It's one thing when you have management on site, but being able to build systems that you can operate and manage from anywhere in the country, but also how we communicate with our teams using technology, using Zoom, right? All these different social apps. We were doing this way before we even got into this environment. So once this hit, for us, there was literally no change. All of our showings were virtual. We were already doing that. And we set up good enough marketing systems where we freed up our manager to focus on our customers, right? And we were responsible as a business for driving all of the leads to our communities. And that made a huge difference. So fortunately, through a challenging experience, we were able to convert that. And that's what I think gave us an advantage in this market to be able to have really good performing assets. And so I'm very grateful of that. But it's because of also a great team, right? I mean, fortunately, I just have some great people in this business that really believe in our purpose of building out great communities and finding ways to improve how people live. And what I always tell folks is if we can keep that the focus, then the natural byproduct is profitable communities. And so that's what we do. And that was the catalyst, by the way, for this show.
Oh, wow. Really?
Yeah. Oh, that's where the name came from. It's our purpose, right? I mean, this is the purpose that I communicate across all of our teams.
Very cool.
And that's how we built out this show, but that's how it started. And that was the catalyst for, that conversation, that vision turned into a purpose. Everybody that's in our organization, they bought into that. And now, we made a decision to live that every day inside of our communities. Right? The idea is to transform them from average apartments to amazing communities.
Got it. Very interesting. Well, thanks for that. That's very interesting.
Yeah, you're very welcome. Well, Jeremy, I really appreciate you being on the show. Very grateful. Insights have been amazing, especially from the viewpoint of a limited partner, a passive investor, someone that's truly passive, right? I mean, I often hear a lot of folks talk about being a passive investor. I think you're someone who has lived that for the last 18 years,
yeah.
Right? But the last 13, where you have taken on this role very uniquely because of your approach to due diligence. So I want to thank you for being a great guest on the show, and I want to wish you continued success. And I really appreciate you very much.
Yeah, absolutely. Thank you for having me on. I just hope that this episode was helpful for your listeners. Do you want to give my contact info?
Please do. If you can share, how our audience can get a hold of you, that would be great.
Okay. If anyone out there, whether you're new or experienced, I'm happy to help any way that I can. If you're new, if you have questions, I'm happy to share. If you're an experienced investor, you want to just network, that's great too. If you have an operator, you have opportunities, or even another investor group that want to network, I'm happy to really talk to anybody. So don't hesitate to reach out. My email is jroll, JROLL, at Roll Investments, ROLL, investments with an S.com. So again, jroll at rollinvestments.com.
Awesome, bud. Thank you so much, and I wish you continued success.
Absolutely. Thank you for having me on. Really hope this is helpful for your listeners.
Yeah, thank you. It is tremendously. Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.